Accounting equation and Excel, reversing entry related to accrued interest. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 5 tabs down below. Example, in essence, the answer key, month 1, first month of operations, month 2, second month of operations, the practice tab, having pre-formatted cells, so you can practice the practice problem with less Excel formatting. The ADJ reversing tab, the one that we will be working in, is where we started with a blank worksheet but are basically working within a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to that example tab to get an idea of what we will be doing. Remembering we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we can and have constructed our financial statement reports, balance sheet, income statement, statement of equity. So what we've done thus far, first month of operations, data input, closed it out. Second month of operations, data input, and then we put a worksheet together for our adjusting entries. Remembering when we're thinking about our adjusting entries, it's useful to think of it as a separate process, even if we're the one doing both processes, which oftentimes we might not be because it might be done not by the accounting department so much as the public accounting firm or the tax preparer or the CPA firm at the end of the year. The objective of the adjusting entries being to make the financial statements correct as of the cutoff date for whatever accounting basis we're using, which might be an accrual basis and or a tax basis. I would usually take the accounting information, even if it's in a software like a QuickBooks and a Xero, and I had access to the software, I would still export that information, make a worksheet, possibly not like this, more like with debits and credits typically, but we're doing it with an accounting equation here so that I can see the adjusting entries in a more transparent format. This format works great for transparency when there's not that many transactions. That's the point. The reason you need an accounting software oftentimes and an entire general ledger report is because there's so many transactions that in a worksheet like this, it would be overwhelming. It'd be too much. But if we're just doing a few adjustments, then this is perfect. It's nice and transparent and we can see everything that's going on. That's going to be the point. Once we're done with that, we could then think about putting it back into the accounting system to make sure that our adjusting entries line up to what's in the accounting system. However, there could be problems in doing that because the bookkeeper has different objectives. It's not like our adjusting entries we're fixing errors so much, although that might happen. We might be fixing some errors, but our real goal is to say the accounting department is doing something different and we're shoring it up at the end of the process, meaning the accounting department's objective is to work with the people they're working with, customers, vendors, employees, as smoothly as possible and try to automate the system as much as possible. And if that means that the timing differences that are going to be used or some categorizations, such as short-term and long-term loans, for example, or the grouping of accounts together versus breaking them out, is easier for the bookkeeping process, or even naming the accounts with like loan numbers in it or something like that, or bank account numbers. If that's easier for the bookkeeper and the accounting department, then we want them to do that. And then our goal on the adjusting process is to shore that up by making the financial statements correct according to whatever basis and then cleaning up the reporting to whatever format it needs to be, whether it be tax return or external reporting. So now we want to put our information, the adjusting entries, back into the accounting system and not mess up the accounting department or bookkeeper. So one way to do that is with the application of reversing entries. Right? Because if I made a change for a timing difference, then they're not wrong. Their timing isn't wrong. It's just not perfectly accrual the way we need it to be for external reporting purposes. So I'm going to reverse it, going back to their system so they can enter their information, achieving the objectives that they have during that time frame. So that's going to be the idea. So in our case, this time we do the reversing entry for interest expense. So what we got to do is look at these adjusting entries we did and determine which of them are going to need to be reversed, and then think about how the reversing entries will happen. Notice that our cutoff date is 2/28. That's the end of the period. We are imagining making our financial statements correct as of that point. And then the reversing date is always the first day after that, remembering that we're sacrificing the middle of the month or the whole middle of the year, right? I'm going to say, hey, look, it's not going to be correct for some part of the time frame, and that's okay, because at the point of reporting, it'll be correct as of that point in time. And by doing this, we'll be able to identify where the adjusting entries and reversing entries are, because all the adjusting entries are on the same day and should be identified as a journal entry form if they're in software rather than an invoice or bill and so on. And they're going to have a note on them saying this is an adjusting entry. All reversing entries will be as of the first day after the cutoff, in this case, 3/1. And they're going to be journal entries, and they're going to have a reversing entry in the memo, for example. All right, and so this one, we had this adjusting entry for interest, and that was due to the fact that we had interest that had accrued that had not yet been paid. So now we're going to, and now we put that on the books, and now we're going to reverse it so it doesn't confuse the accounting department. All right, let's go back to the adjusting tab and think about that a little bit more. I'm going to go up top and say, this is the one. I'm going to try to connect these together with color coding. So let's make this one yellow, for example, and then I'm going to go down and say, now I'm going to go 3/1. The reversing entries are always the first day after, and this is going to be reverse and accrued interest. Accrued interest. And so I'll make this one, again, yellow. And you might number your adjusting entries so that you can tie the reversing entry out to the adjusting entry. Some software, actually, I didn't spell this right, reverse, something like that. Looks a little better. Some software actually has the ability to reverse the entry automatically. So you can just say, take that adjusting entry and make a reversing entry right after it, or something like that as of the same day. And hopefully they can kind of tie those two things together, which would be nice if you could tie the forms together similarly to tying like a payment form to an invoice, for example. But here's what we have. So we're going to do the reversing entry. So let's go up top and remember what we did with the adjusting entry. So this was an adjusting entry for the loans. And we did the short-term loan is the one we're focused in on here. So let me see if I can, here it is. So here we did a $5,000 loan. We said it was only for a 3-month time frame. We had a high interest rate because we wanted to make it somewhat significant, the dollar amount, although it's still pretty small. And then here's the payment. So here's what happened. We had the loan of $5,000. Here's the amortization table. The problem is that we pay the loan off in the middle of the month. And that's fine so that means that even if we track the amortization table, even if we break out the interest and principal according to the amortization table, there's going to be 15 days that we had the purchasing power of the loan for which we haven't recorded the interest. And remember, the interest is similar to like if we rented a building and we signed a contract for the building, but we hadn't yet paid the rent. So we used the building, but we hadn't yet paid the rent. Well, that means that we should record it as an expense still, right? Because we can't get out of it right at that point in time. They're gonna, if we try to not to pay the rent at that point, they're gonna sue us, right? So similarly here, we're paying for the purchasing power of the $5,000, and we should be recording the interest as we consume or use that $5,000. In other words, as time has passed and we've been using the $5,000. So after the first payment was, so we're saying it was on the books at 5,000, 15 days have passed where no interest has been accrued, even though it's going to be paid on 3/15. So the interest as of 3/15, according to our table, is $146. But half of that should have been half of that should have been before the cutoff date. So what we did is we made an adjusting entry saying I'm going to record interest expense of $73 before the cutoff date, and I'm going to record the other side as interest payable or accrued interest, a liability as of that point in time. So that's fine. We made that perfectly correct now. Now note that this is a small dollar amount, so it might be immaterial. You might say, what's the $73 might not be significant for decision making for larger businesses, but you can imagine a lot of loans for business loans might not follow this same pattern being paid off in monthly installments. It might, for example, be a balloon payment that you pay at the end of the loan. And in that case, you can clearly imagine it could be quite significant that you haven't been paying off any interest on the loan, and it's continually accumulating upwards. And if you didn't record it, it's going to basically cause a problem. Now, also, I just want to note that in this particular case, you have kind of an option. You could leave this on the books as interest payable, and it probably wouldn't mess up the accounting department too much because it's in its own account. And you could just wait until the next year or the next month, whenever you're doing the next financial statements, to basically adjust this or reverse this yourself at that point in time. Or you can reverse it now so that it doesn't look funny towards the accounting department. So let me give a quick format in terms of journal entries as to what happened. So we put this on the books. If I looked at it in terms of debits and credits, we said interest expense, and I'm going to say debit is 73, and then we said interest payable, a liability, I'm going to say negative 73. Now, if we don't take that off the books, then the next payment that they put together should take that kind of into account. They might try to get that off the books as they record the next payment, right? So then the next time they make the payment, it would be something like they're going to say the payment, let's just say cash, is going to go down by the full amount of 1,765, and then they're going to have to reduce the interest payable. So interest payable would have to be going down by 73, and then they're going to have the interest expense for and then they're going to have the differences in interest expense is going to be the other 73, this minus the 73, and that's going to give us and then the loan payable is going to go down by the negative sum of these, and the loan payable decreases by that 1,619, right? So they're probably not going to want to do that, right? Because it's already complicated enough to have this situation to have to deal with the accrued interest already. So what we really want to do is just, if they're going to go according to the amortization schedule, then they should be able to just record it like this. Cash is going to be decreased by the same amount, 1,765, and then they're just going to record it to interest expense that would be the normal thing to do, which is going to be the 146, and then the loan payable would be, this is going to be a positive 146 negative sum of these two. So if they're following their amortization schedule, this is what you would think they can normally do. That would be the easy thing. That would be the easy thing to do, at least somewhat easy, following the amortization schedule. This is going to be somewhat wonky to them. That's going to be even a little bit wonky because now they're going to have to figure out what we did and reverse it as they do the adjusting entry. And their goal isn't to figure out what we did. That's the problem, because we want to keep those two things kind of separate so that they can focus on what they're doing. And we could even go further than that. They might not be using the amortization schedule at all. Maybe they're just recording the payment reducing the loan with every payment, and then we make the adjustment for the interest and accrued interest as of the end of the year. And that way they can actually automate the whole system with bank feeds. But we're imagining they're going to follow the amortization schedule. So let's go back on over to our report then, our information over here. So notice, just to point out that the loan payable that we're looking at is here, the loan payable, and the interest payable is 73. Now, because it's in a separate account, we could just tell them, hey, look, just don't touch the $73, and we're going to make another adjustment for it for any accrued interest as of the next accounting period, and just record your normal loan as you normally would, because the 73 isn't part of the loan balance, and they could still just tie this out to the loan balance. But it's still kind of ugly because they got this 73 and they're going to be like, where did that come from? So we can reverse it. So let's go ahead and just reverse it and say this is going to be for the 73. And we'll just reverse it as of the first day after the cutoff. So this is going to be negative of that. And then the funny thing is, over here on the income statement, we got interest expense, which is going to be, I'm going to say negative of the 73. Wait, no, positive of the 73. So that's why it's funny, because usually the expense brings down net income, which we've been represented with a negative, like an interest expense here. This time it's going to be a positive. So that means that the accounting department still might be a little confused, because they're going to go, hey, look, I ran the income statement and I've got $73 as a positive expense, which is going the wrong way, because normally expenses always go the one way. It's the analogy of the car. How far can I drive in a day? It always goes up until we reset the odometer. So in this case, you got to go in the wrong way. And it's like, well, yes, that's true. And that's because we're reversing the last transaction. It will be correct when you record the interest expense, because when they record the interest expense, they're going to record the full amount, which is the 140 or whatever, right? The 73 times 2. And so they're going to record a negative double that amount. And if you net the two out, it will then net out to the proper amount of $73, right? So that's going to be the proper amount that should be recorded in the current time frame. So that's the idea of it. Now you might also say, well, look, you're not going to do the reversing entry until the 15th of January, because that's when the payment is due. So it would actually be a little bit more correct if you didn't reverse it until the January 15th, and then those two things would match out on the same day that they make the payment. So why are you doing it on 3/1 when you'd have 15 days of more correctness and not have this negative amount if you posted it as of the day they're going to make the payment, which is January 15th? And the reason is, we're saying that'll get confusing, because now we're not going to be able to find all the reversing entries. If we scatter the reversing entries across the month, then when we look and try to run a report for the reversing entries, it's going to be difficult. We want to clearly identify the adjusting and reversing entries, and therefore all reversing entries are going to be on the first day of the following month, which will then shore up at the end of the month or whenever we do the next adjusting entry. So that means we have 15 days that we're sacrificing. We're saying, hey, it's not going to be perfect for these. You can have this ugly $73 looking funny going the wrong way, but we're able to find the reversing entry clearly, and we know that it will be correct as of the time you make the payment, and or make the process as easy as possible until we do the financial statement adjusting entries again next year or month or quarter or whenever we do them. All right, that's the idea. So let's go ahead and put some zeros across the board. Zeros across the board. Zeros across. Oh, not there. Not there. All right, it's okay. I can reverse it. I fixed it. I fixed it. Don't panic. I can fix it. I know stuff. I know how to do stuff. And then I'm going to underline this. Let's go to the Home tab, Font Group, Underline. And then we'll bring down the balance. Let's see if we're in balance thus far. Selecting these items, pulling them down. So their liabilities went down, equity went down. It's a classic reversing entry because it was a classic adjusting entry, meaning there's an income statement component to it. It's a timing difference. So we'll sum these up and then copy this. Oh, that's a copy. And then we'll scroll on over and paste it with just the formulae. All right, so there we have it. So now we've got, let's pull down the formatting on the signs. And so there, now we have, again, this kind of funny bit sitting out here with the positive 73 in the income statement, or like an expense going the wrong way, but that's cool. We're cool with that. We're ready to explain the rationalization or why we're doing that with the bookkeeping or accounting department when they ask that question. And then that looks good. We're going to underline here, put an underline, home tab, font group, underline, and there we have it. All right.